Hello, this is Martin from seekedge, the channel for learning about trading and investing. Today we are going to talk about a very interesting topic, slightly different from the stocks and indexes that we have been talking about. This is option trading using the currency pair USDINR. So, what is currency trading? So, there is inequality between the currencies that exist, across different regions, right? Due to various reasons, economic and political reasons, right? So this is the primary reason why, right, the need for the currency trade emerges from here. And who are the participants in this currency trading, right? The basic participants are the basic trading for the currency is happening. It's also known as foreign exchange. It's right. It happens between the banks, between central banks, bankers, travelers, hedge funds, importers of commodities and exporters, right? And of course, the traders who want to arbitrage or make benefit out of derivatives, etc. Right. So these are all the different participants in the foreign exchange, right? And currency trading involves large volumes, and also it involves very high leverage that's offered for that. It works 24/7. It's not like ours, NSE stock exchange. It works only on a stable time. Globally, the global forex scenario is that it works 24/7, 6 days a week operations, right? So that's what makes it attractive. So it's a multi-billion-dollar trading uh, environment that we're talking about. Globally, the forex is all about that. Now, currency trading, you can see that there is a base currency and there would be a quotation currency. The base currency is like, for example, USDINR means base will be the US dollar. INR would be the quotation currency. So the movement would be based on the base currency rate, right? So when you say USDINR appreciates, USDINR, the US dollar appreciated. That's what it means, right? So, the global institutions is what we have been talking about till now. So globally, there is a big forex, multi-billion-dollar forex market that happens. A lot of trading happens between the banks and traders and boards and exchanges. So it's a different thing in the sense that we're not going to get deep into that part. It is something that happens mostly at the institutional level or in board exporters level, right? So there are ways of participating in that through some brokers, uh, but I'm not sure how the compliance of doing forex trading, using sub brokers, that is linked to some institution that is abroad. Not about the reliability, the compliances, and and the security, the risk involved would be very much different if you're participating in the forex market outside. No, I'm not talking about the global forex market as a retailer, as an individual, right? But here we are going to talk about the same currency trading in the derivative sector that's traded in the National Stock Exchange, not NSE, right? And the transaction takes place. And NSE is one of the financial institutions, right? Globally, the forex trading happens across multiple financial institutions. So the main problem there is that there is no centralized uh, international exchange which coordinates all that, and you know who is the sole agency. There is nothing like that globally, right? But we have in NSE, right? There is a trading in currency pairs of different currency pairs, USD, INR, Euro. We're talking about only the USD, INR currency pair, right? So I already mentioned the appreciation and depreciation of the currency. What does that mean? There will be base currency and the quote currency. So base currency is USDINR. If the USDINR is called a pair, US dollar is the base currency, and the quote currency would be the INR. So US dollar appreciates is what USDINR appreciate means essentially, because that is the base currency, right? Similarly, rupee weakens, but right when we say depreciates, no, the USDINR depreciates means the rupee weaken or the dollar strengthened. That's what depreciation of the USDINR means. So these are some terminologies and terms that you have to be aware, the back of your mind while you are doing that. Now there are different advantages. Why do we need to know about the trading of options on this particular instrument of when we already have many instruments available already, indexes are there, stocks are there, still why do we need to? So the main thing is the low margin requirements. That's a big plus point, right? The low, for one lot, we'll see the details later. It's very less margin that is required. That's a boon for some of the option traders, right, if used properly. Now another thing is the less volatility. Like, it's always range bound, so you cannot have a dollar that shoots up to 90 rupees, right, as the exchange rate. That's very unlikely to happen. So most of the time, depending on the fundamentals and the economic conditions and what the central banks interest rates and multiple things, the price variations is normally most of the time it is in range bound, and range bound is very attractive for options trading. We already know that. Now there is a low liquidity problem sometimes because the participation is less on the currency pair trading, not at the global level. I'm not talking about global. Forex is very hot and active and multi-billion, large volume, highly leveraged place, but I'm talking about the NSE, introduced derivatives currency trading, is catching up. There is enough and more liquidity that is there, but when you go for OTM towards the last week of the expiry and all, options may face some difficulty in the liquidity, but that is not a big concern, right? But in general, as when you compare the liquidity or the liquid equity or the index which has got high liquidity, it is not that liquid. That is something that you have to keep in mind. So do not extend your trading positions in the options to the end of the expiry, right, nearer to the expiry. That is something that you understand. Now, more leverage, we said, we can get to buy, to scale up our positions and get to invest our capital and position sizing accordingly, but with a less capital as compared to other stocks. But the problem is the more leverage is given by the NSE, but that is also can turn out as a disaster. If you don't position size properly, we take more lots than we can afford. Because always the risk in currency is the upside. Currency can suddenly shoot up, and very small move of $1 or few 100,000 point moves can wipe out the entire account, right? Because it will be so it will be large institutions who may be participating, and it will be so sudden that there won't be any opportunity for the adjustments to be done. So you have to be very careful when you are leveraging. Leverage only 1%, 1 to 2% of your total capital for one position, right? Not more than that. Another thing that we have to keep in mind in the currency pair is that there is a global dependency. So even though we are not directly participating in the global forex market, there is a dependency. As soon as the global factors like interest rates or Fed meeting or RBI interest rates and inflation, GDP, and all these factors affect, and most of those are 24/7, right? So by the time we get up and come for the trading for our market the next day, during our daytime, a lot of events might have happened. There is times of gap up and gap down kind of scenarios, right? And Reserve Bank or the central bank does interventions in between based on the fundamentals of the economy. They don't do that just like that. They do it as and when it is required. So so that is the reason why it is range bound, and it does not shoot up to unbelievable levels, just like the chances of that happening in a stock or index, right? Now again, there are several factors that are impacting. So we cannot be an expert in the entire aspects of economics and try to understand which way the price of the price of the currency is can move up or not. So apart from the technicals that we know only about, there are a lot of fundamental factors, right, when you are coming to currency which we may not fully know, like inflation, the impact of that, interest rates, RBI policies, and GDP growth forecast, budget, and the US Fed meeting implications. All these things we will not be able to 100% understand beforehand, and it happens not in our time zone most of the time. So these are some of the risks and some of the cons you can say to some extent, when you are doing the currency pairs. But the margin requirement and the range bound is a great thing about the options in general. Now USD-INR currency pair, the symbol is USD-INR. One lot is 1000 US dollars. So the tick size here is not like in the stocks or the equity, right? The tick size is 0.25. That's you always consider it as 4 decimals, so 0.0025, because the currency pair is expressed in 4 decimal points, like 75.5645. So that's the 4 decimal part and the rupee part. So that's how it is. The tick size is point. So every tick 0.25 paisa movement happens. Now, what is the underlying price or the spot price for this currency? It is the RBI reference rate. There is only futures options charge the broker provides. There is no spot chart. The spot is based on the RBI's reference rate that is published in the afternoon or something. Right? That's the basic consideration for the entire derivatives. Now, expiry is at 12:30 p.m. every Friday. That is also different. You have to keep telling me. And monthly expiry would be 2 days before the last business day. That is well. So all these details will be available with the brokers, right? And the margin requirements, approximately 2,500 if you are doing the option selling, at any of the positions, right? Settlement is in cash and it is T+1, right? So these are certain factors. This is an instrument just like indexes, Nifty 50 or Infosys or any other stock. This is another instrument. It has got its own tick size and its own expiry, its own margin requirements, its own spot underlying value, its own timing. The timing is 9 to 5 p.m. 9 o'clock starts, right? The stock market starts at the normal other indexes, and the stock starts at 9:50. This starts at 9 and extends till 5 p.m. right? And the expiry timing also. So there are things that you have to keep in mind. Margin requirements. So these are some of the formulas that you can that I put across. While we are for quick reference, you can use the same. So the margin is actually what is the lot size. So so what is meant by the margin here mentioned here is a contract value. No, it's not the actual margin. The actual margin comes to 2,500 per lot. But the actual margin's contract value is lot size multiplied by 1,000 into the buy price. Buy price in the sense the dollar value. That comes to, if you're, it comes to 75,000 rupees. If you say that 75 is the dollar rate, 75,000 rupees is what one lot is actually worth. But you are getting it at 2,500 rupees. You are getting it. That is a 30-40% of leverage is what you are getting. So one lot is one. So the points is like So suppose if you see in the right top, the buy price, suppose we buy the USD-INR instrument at 75.0555 and then sold it at 75.0755. So there is a movement of 200 points have moved, right? So that 200 it represented in 4 decimal points, right? So if you say the 200 point consists of 8 pips, so 0.25 paisa is it. So how many of that consists to? So how many of pips makes that points of 200 is what is represented here. So the formula that you calculate is right, the pip size into the tick size into the number of lots, right, and into 1,000. For example, here we are having 10 lots and 8 pips. The moment happened 8 pips. So we got 0.008 pips of moment happened. Tick size 8 ticks happened. Every tick is 0.25 paisa, and total PNL we made 200 rupees, right? Contract value for that is 7.5 lakhs, but what we paid is hardly 22,500. So that's a good return of investment. We made 200 rupees just for 8 pip moments or 200 points of gain. We made 200 rupees for a margin value of This highly leveraged margin value of 2,500 per lot if you're just selling one option, right? So now in addition to that, there will be brokerage. Brokerage rules are all the same, as like options, no? So per order or per lot, depending on the broker. That is in par with the how you trade options in indexes. So here is an example of brokerage calculator for this zerodha. You will get to know what is a brokerage exactly. You can go to there, just Google out there brokerage calculator zerodha, you will get to know. The margin required, for example, so this is the zerodha bracket order box where I have added USDINR August 75 call option. CDS is currency derivative segment. CDS currency derivative. So USDINR, this is a kind of a triangle. It's a straddle actually. 75 call, 75 put sold. Right? For selling this kind of a straddle, it will cost you 2 lakh, 1.5, at least 1 lakh, in Nifty or indexes or stock option may cost 1 or 2 lakhs, right? Here the total cost is coming to only 23,000. You sold how many? 10 lots. So for 10 lots, you hardly pay. Just have to say, spend only this much, right? So that is about the margin requirements. The currency pair, you need so in order to, just like any other stocks and any other instrument, you need to have a chart to look at. So we have the broker will provide the USDINR futures for each month. That is how do you normally look for knowing about the price and deciding on the option strategy or start building the strategy. Option chain side, if the currency segment has got separate option chain is there. You can see there. There you can see the option interest, the IV volatility. All the things in the option, everything remains the same. All the option principles are exactly the same. Now there are some options, USD, INR, payoff Excel sheets. If you Google, you can find out where the strategy, the payoff diagrams can be there in the Excel sheets, and also option open interest data also can be derived in some of the Excel sheet based free sheets are available in the Google. You can find them. Another option is to use Option Oracle. It's a open source tool. It just got payoff charts, which is also used for building a strategy. Just like Upstrike, Upstrike does not have USDINR. And Sensible has that. They have strategy builder, options data, and they have payoff chart also. These are the normal tools that is used for any option trading, right? Now, broker margin calculators. You can calculate the margin in the same place, but choose the currency derivative options. The CDS currency instrument has to be chosen instead of the stocks. So these are the basic tools that we use for trading options. So here this is an example of a payoff chart for the Sensible that is provided in the zerodha. You can see that it's a straddle. It's an iron fly actually, basically 74.75 put and 75.7C put with the value of 0.4450, right? 0.135. So and the max profit is automatically calculated to so the only thing that we need to know the difference is that we should know the tick size and how to calculate the PNL, right? How much is the total margin requirements? Other than that, it is all the same, right? So any price movement, we already saw that in the previous slides, right? How we calculate the PNL, right? Whenever there is a certain points of movement, so that is what you see here. So it calculated the maximum profit, maximum loss, and the break-even point. So as long as the currency is staying between 74.78 and 75.22, if it is in the expiry, if it is closing like this, you will make this much profit per lot, per 10 lot, because this is 10 lots iron fly, right? Iron butterfly, right? That means you have a straddle and then you have two hedge positions. So never go for naked or unlimited risk strategies of options in USDINR, because there is an overnight risk which can be deadly, right? So always go for hedge strategies. So this is an example of a payoff chart provided by Sensible inside zerodha. Now option strategies like iron fly, fully hedged, right? You know exactly what is, it's non-directional, so it fits in the USD currency very well. We know exactly how much is the risk, we know how much is the maximum profiting, we know the probability, we know what is the break-even points. All this is known for iron fly and condor. And also you can go for credit debit spreads. If you're not seeing the credit debit spreads and iron condor strategies, you go to the description and you will get the link for that in the same option beginner series. Refer to that. So same things can be applied, only the instrument is changing. So if you have directional, you can go for credit and debit spreads. If you're non-directional, you can go for IFI and ICON. All are hedged and defined risk. And here, the exit early is very important. Right? Do not wait for the expiry day. You will not get liquidity. You may have sudden moments that happen. The expiry will be the gamma effect, and then you will lose out. So exit early, enter early. Enter at least 1 month if you're 1 month ahead, or 10 days ahead before you do the weekly or monthly. Okay. Now analyze the technical charts of the futures chart sets available and then find the resistance and support levels. Right. You should have form a view on what is the maximum action of this currency as per the charts, and then according to the charts you should take a view and then decide whether you want to go for directional or non-directional. It's all the same. The only instrument changes. Expiry is there for weekly and monthly as both are there. We'll decide which one. Right. Weekly will have more premiums available. Monthly will have to be very early. Whichever is appropriate fitting into your plan, trading plan, you take. Adjustments has to be done ahead of time. Other same rules apply here. Before the break-even points can be calculated by as per the strategy of the options that you are using, and then if that is calculated, then you do the adjustments prior, not wait for the break-even to breach, because after that it may be difficult to adjust. Yeah, unhedged naked should because upside is very tricky. The risk is in the upside, not Nifty indices. The risk is on the downside. Here it is on the upside. Something you have to keep in mind. Now, yeah, position size rules. Yeah, as per the rule of capital. Yeah, 1% actually. It is not 15. There is a mistake here. It's a 1% rule, or 1 to 2% of the total capital is all that you have. Do not over leverage and take more number of lots, and and if you go for unhedged, you'll be in big trouble. Even if it is hedged, the position sizing has to be as per your capital and risk management. Not just because you're getting leverage. If you go for this, you will end up in a disaster. You will end up in very big, huge losses. More leverage that you're taking without, always think that you take you're taking almost 1 lakh of risk exposure when you're taking one lot. That way, if you plan, you would not take too much of risk and you would not take too much of leverage, right? So, and always go for hedge strategy so that you know what you're going to lose in the worst case scenarios, right? Now, this is an example of an option oracle is a tool for, that I try to create an IFI, right? Earlier we saw that in sensible tool inside zerodha. Here we are showing option oracle. Here you can see that the break-even points are exactly known, right? The upper protection is 74.72, lower protection is 74.27. So as long as the market closes for this August month expiry within this range, there is no worries. You will do anything, you will end up in profit of 4,500 max profit. That is only the max profit. You don't need to necessarily get that. Depends on where it is ending. So this is very thin, narrow one, just for example. But actually you can widen it depending on what hedge. If you don't want to lose too much, then you make it narrow. If you are okay to risk and put a buffer for adjustments, you can make it wider. So this is an example of iron fly, and this is an example for a bull spread where you're selling a higher strike, right? 75.25. Right now it is 74.5. A higher strike is sold and the lower strike is bought. Bull call spread. So as long as it is in this range of 74.58 and 74.5, yeah, some correction has to be there here in the break-even points. But yeah, so so it's in the central point. So as long as the price does not move down in that certain range, the bull call spread makes money. So it is direction. You are in a you are in a bullish mode. You are expecting the market, the US dollar to further strengthen within the expiry limits in the August month. Right? That is what you are taking a bull call spread. If you are not seeing the bull call spread, bullish spread videos, and iron counter or iron fly, if you are not if you are not aware of that, check the description. You will have a playlist for that, and you can go through that. And it's the same option strategy that is applied on a different instrument here. That's all. Now, just to summarize, USDINR options for the beginners, the advantage, the very reason why such an instrument is being talked about as a separate video content and presented to you is because for beginners it helps a lot to learn practice. The concept of the options are the same. It's all the same. The theta, gamma, whatever Greeks are there, the time decay, anything, everything, anything about options works the same. So this helps as a tool for learning and practicing. And yeah, so the advantage here is that you don't have to spend a big margin and you can take few lots and learn. So you can focus on one single to gain expertise and practice, and then you can practice it with less risk and less volatility. So you don't have any other instruments like that to practice on. You have to burn yourself by taking risking too much on option selling and then the thing. So this is the best place to learn with less risk, and because it's range bound. Right? For experienced traders, you can take the advantage of the risk. Leverage helps you to scale up in a good way. If it is very much within your risk management plan, right? So you can take advantage of the leverage that we are getting and then scale up your position sizing, and then have a good return of investment, reasonable and very good return of investment from the capital that you can get that. Then range bound bracket is the best for trade non-direction. So you always wish for a sideways movement or a hardly any movement. You always expect that, but the indexes cheats us, the stocks cheats us most of the time, right? Nowadays, especially when the volatility goes here and there. But currency market is stable in that it's always, most of the time, it is a range bound. So that gives us the price to remain in the levels that we are getting from the charts, and then the probability of winning is more. But the quantity, the amount of money that per lot that we are getting may be less as compared to the stocks in this, but we can always scale it up as per your position sizing. Now, it always diversifying instead of trading only in stocks or trading only in indexes. Having the same options learnings to be applied on a different instrument is always a hedge by itself. It is a hedge. And if for example, if the market does not work, or the Nifty does not work, probably the index may give you money for that week or that expiry, right? So that's always a hedge by itself. If you look at the trading portfolio, when you are doing multiple strategies on multiple instruments, always good. So that is how it helps the experienced person. That's a summary of what options, USDINR options trading, derivatives trading. I hope it helps. It gives you an overview on what about. If it is unknown to you, this will be very useful for you to experiment with. You could always start with one or couple of thoughts, risk defined strategies that you already learned. You can apply that and see how it goes, without burning yourself. So I hope it helps you to get introduced if you're not introduced. And also, if you like it, please hit the like button and share it to maximum number of people. There are a lot of people who thinks that this is something very difficult to do, or something that does not have liquidity. I have various misconceptions, conceptions about this particular instrument, right? But at the same time, a lot of people who are making money also on this, right? This is a good hedge not only for your portfolio, but this helps your other businesses also. This can act as a hedge if you're doing both export and kind of businesses with that is based on the US currency. So please subscribe and share to maximum number of people, right? And that is the only thing. It does not cost you anything just to hit the like button and subscribe and share. If you keep giving that, we will come out. I promise that we will come out with future videos with strategy specific currency derivatives videos for sure if you get more subscriptions for our channel. I hope it helps. Happy trading, happy learning. Thank you.